Joining us now, Krishna Guha, Evercore ISI Head of Global Policy and Central Bank Strategy Team. Krishna, great to see you. Thanks so much for joining us. I mean, clearly there's rhetoric from pretty much all corners that wants to see stimulus. Whether or not we get it, I guess, remains to be seen. But in the eventuality we saw something small now and something bigger, medium term, early next year, where will the 10-year be in 12 months' time?
Well, that depends on a lot of things. Above all, how the vaccine developments play out, as well as, many other things. But no question, having some timely fiscal now and then some sustained fiscal support going forward would be very, very important. In a benign scenario, you could see the 10-year 125, even 150 a year from now. But there's a lot of things that need to get right between now and then.
Do you think that Janet Yellen as nominee for Treasury Secretary is bullish overall for risk assets and for yields?
I think Janet certainly is superbly qualified for the job. And I think, her nomination and more broadly, the rest of the team that's been designated, this is a team of pros, experts, competent people, also people who work well with the Fed. I would say that, I'm a huge fan of Janet Yellen, but there are aspects of the job, the political side, the negotiation with Congress, where she doesn't have, that much expertise. So it's not like Janet Yellen is a silver bullet for all our problems, but we have a lot of challenges. It's great to have someone of her caliber in that seat.
And what about the outlook for the dollar? I mean, clearly it's been pretty weak already of late. Do you think next year is another weak year for the dollar?
So I have been expecting a dollar weakness, and my inclination is to think that that will continue to play out going forward, really for a couple of different reasons. One is just that as stress and risks to the global outlook moderate, in particular with ongoing progress on vaccines, that might tend to favor some moderation in the dollar. But also, and crucially, because I think you have a very strong commitment from the Fed to keep monetary policy extremely easy as we move deeper into the expansion. What that's actually going to mean is that real interest rates, adjusted for inflation, are actually likely to fall, at least at the front end, as we move deeper into the recovery. And real interest rates generally tend to be quite influential on currencies. So this is an unusual situation. Don't normally expect real rates to be falling as you move deeper into a recovery, but that's what we're likely to see in the U.S., distinctively in the U.S. And I think that that's something that will likely weigh on the dollar. Of course, that then gives opportunities in particular for emerging markets. It makes life more difficult for the Europeans, for instance, who have to deal with that euro strength.
Krishna, great to see you. Thanks so much for joining us.
Shepard Smith here. Thanks for watching CNBC on YouTube.